you go, wanna hear you go.
Imagine walking into a bank, right? You ask for a $10 million loan, you hand over absolutely zero collateral, and you get approved, executed, and settled in like less than 12 seconds.
Which is just, impossible in the real world.
Completely impossible. In the traditional financial world, that gets you laughed out of the lobby. But on the blockchain, this is happening hundreds of times a day. So welcome to today's deep dive.
Glad to be here.
Our mission today is to figure out how a few lines of code are actively replacing traditional banks, middlemen, and, human loan officers.
Yeah, they're just gone.
Exactly. We're pulling from this really fascinating stack of notes from a series titled DeFi Mechanics and Market Power. And we're going to focus on three specific protocols that are basically rebuilding credit markets from the ground up. Those are Aave, Compound, and Morpho.
And what's fascinating here is that this isn't just about borrowing a few dollars online for a quick trade.
Right.
We are talking about the very foundation of liquidity, leverage, yield, and really market structure on the blockchain. These protocols are creating a completely new financial physics.
A new financial physics. I like that. And that is exactly why you, listening right now, need to care about this. Even if you have absolutely zero intention of ever interacting with crypto or buying a token or whatever. Because these protocols are actively writing the blueprint for the future of global, transparent, and fully programmable finance. The mechanics are just mind-blowing.
They really are.
So let's unpack this. For an audience that already follows the space, we know the basic premise of a collateralized loan.
Right. You lock up an asset, you borrow against it.
Exactly. But without a human loan officer sitting there reviewing your file, how does this system actually calculate, execute, and enforce these loans autonomously?
Well, it requires a complete paradigm shift, really, away from identity-based trust. On-chain credit relies entirely on smart contracts, over-collateralization, and these really strict algorithmic risk parameters. You don't have a credit score here.
There's no FICO score.
Exactly, no FICO. Money moves through shared liquidity pools. So depositors put assets in, and borrowers lock up collateral to take assets out. But the critical mechanism that replaces that loan officer you mentioned, it's the math dictating your borrowing power, and crucially, automatic liquidation.
Right. Because if I go to a traditional bank, they look at my income, my credit history, my job. Here, I'm just an anonymous wallet address.
Yep, just a string of letters and numbers.
So I have to put down more value than I'm actually taking out. It's like a fully autonomous robotic pawn shop.
That's a great way to think about it.
But wait, a normal pawn shop has a human owner.
Right.
Someone who can look at the gold watch you brought in, weigh it, and know what it's worth today. A blockchain is inherently blind to the outside world. It doesn't know what a watch or a token is worth. So how does the code actually know the real-time value of the collateral I'm locking up?
So that's where we have to introduce this concept of oracles.
Oracles.
Yeah, an oracle is essentially a decentralized data bridge.
Okay.
It constantly pulls real-world price data, so the current price of Ethereum or a specific stablecoin from various external exchanges, and it feeds that data directly into the smart contract.
Got it.
So your robotic pawn shop relies entirely on that oracle data to calculate your collateralization ratio, literally second by second.
Okay, so the oracle is like the eyes of the operation.
Precisely.
And if the oracle says the value of my collateral just plummeted below the required threshold, I'm assuming the machine doesn't call me up to ask for a top-up.
Oh, definitely not. There's no courtesy call. It just acts instantly. The smart contract immediately triggers a liquidation. But, and this is important, it doesn't just vaporize your collateral. The protocol actually incentivizes third-party users, they're called liquidators, to step in.
Okay, so who are they?
Just anyone on the network. The code essentially offers your collateral at a slight discount to anyone willing to immediately pay off your debt.
Oh, I see.
Yeah, it ensures the lenders in the pool are always made whole, and the protocol remains perfectly solvent, entirely without human intervention.
It's just ruthless efficiency. There are no grace periods, no haggling with the manager, just algorithmic enforcement.
Exactly.
And this whole concept of shared liquidity pools, this didn't just pop into existence overnight. The source material points to Compound as the protocol that really defined this model.
Yeah, Compound was a massive leap forward. They pioneered the shift from peer-to-peer matching to what we call pooled lending.
Because early DeFi was pretty clunky, right?
Oh, incredibly clunky. If you wanted to borrow, say, 100 tokens, You literally had to wait for the system to find a specific lender offering exactly 100 tokens at a rate you both manually agreed on.
Like a weird Craigslist for loans.
Exactly like that. But Compound changed the game entirely by aggregating everyone's funds into one massive decentralized pool.
Okay, but if everyone's funds are just sitting in this giant digital pool, how do the lenders actually track what they are individually owed?
Right.
Like if I deposit my money, it just mixes with everyone else's. How do I get my specific yield back?
Through this really clever innovation called tokens.
So tokens.
Yeah. So when you deposit an asset into Compound, the smart contract automatically mints and sends you an equivalent amount of SEEP tokens like CUSDC or CME.
So it's like a digital receipt.
Exactly, like a coat check ticket. But what's crucial is how they accrue interest. The exchange rate between that SEEP token and your underlying asset algorithmically increases over time based on the interest being paid by the borrowers.
Wait, so the receipt itself gets more valuable?
Yes. So when you eventually go back to redeem your poke tokens, they are mathematically worth more of the underlying asset than when you started.
That is incredibly elegant. It's an interest-bearing receipt that just updates in real time.
It really is.
But that brings up the interest rate itself. If there's no central committee, no Fed chairman setting the rate, how is it determined?
It's governed by a mathematical formula known as a bonding curve.
Okay.
And it's driven purely by utilization. So the code constantly looks at the pool and asks, how much of the total deposited capital is currently being borrowed?
Right.
If utilization is low, meaning there's plenty of cash just sitting around, the interest rate algorithmically drops.
To incentivize more people to borrow.
Exactly. But if utilization spikes and that pool is running dry, the bonding curve triggers this steep exponential increase in the interest rate.
It's like an algorithmic chokehold.
Yes.
If the pool is almost empty, the cost to borrow just skyrockets,
Right.
which forces current borrowers to repay their loans quickly, replenishing the pool for lenders.
Exactly. And that mechanism is entirely transparent.
Yeah.
Now, the source material explicitly refers to Compound as a, quote, minimalist credit engine.
Right, which is exactly what I wanted to push back on.
Oh, really?
Yeah, because if we are talking about the foundation of a brand new global financial system, one that's handling billions of dollars, shouldn't the architecture be highly complex to ensure security? Calling it a minimalist engine almost sounds like, I don't know, a liability.
Well, if we connect this to the bigger picture, you'll actually find that in the realm of smart contracts, complexity is often the enemy of security.
Oh, interesting. How so?
Every additional feature, every extra line of code, it exponentially increases what we call the attack surface, basically the number of ways a hacker might find a vulnerability.
So more code equals more places to hide a bug.
Exactly. So Compound's strength is its rigid simplicity. It does one thing and one thing only: over-collateralized cooled lending.
Right.
That predictability and minimalism make it incredibly stable. It's the bedrock that institutions trust specifically because the code is so straightforward and heavily battle-tested.
Okay, that makes sense. So Compound is the sturdy, minimalist checking account. But human nature dictates that if you build a super solid bedrock, the very next thing someone will do is try to build this sprawling, highly complex skyscraper right on top of it.
Of course.
If power users feel limited by Compound's minimalism, they're going to look for a protocol that pushes the absolute boundaries of what code can do.
And that evolution leads us directly to Aave. If Compound is the original credit engine, Aave is essentially a liquidity operating system. They took that foundational pooled lending concept and built a sprawling financial app store right on top of it.
Here's where it gets really interesting, because the notes contrast these two perfectly. Aave is just packed with features that seem to completely defy traditional financial logic.
Oh, totally.
The most glaring one being flash loans, because you mentioned earlier that all on-chain credit requires over-collateralization. But Aave offers massive loans with zero collateral.
Zero.
How is that not just handing free money to hackers?
No, it sounds completely impossible until you understand how blockchain transactions are actually processed.
Okay, break it down for me.
So, a flash loan takes advantage of something called atomic composability. On a blockchain, a transaction isn't necessarily just one single action. It can be a sequence of really complex operations bundled into a single block.
A single block of data.
Right. So Aave allows you to borrow as much capital as you want from their pools, completely without collateral, under one absolute mathematically enforced condition.
Which is?
The borrowed amount plus a small fee must be returned by the very last step of that exact same transaction block.
Okay, let's unpack this. You're saying the loan, whatever trades I do with that money, and the final repayment all happen inside one single instantaneous block of data.
Exactly, within milliseconds.
But what if my trades lose money? What if I borrow $1 million, make a bad trade, and I can't repay it at the end of the block?
Then the smart contract simply invalidates the entire sequence.
Oh, wait, what?
Yeah, the transaction just fails. The blockchain rejects the block, and the state reverts as if the loan was never issued in the first place.
So it just hits undo.
It hits undo. The code mathematically guarantees that lenders face absolutely zero counterparty risk.
That is wild. So it basically allows developers or, arbitrage traders to execute massive multi-million-dollar market corrections using OIP's liquidity. And if their math is wrong by even a fraction of a percent, the code just says, nope, never happened.
Exactly. It's a superpower for traders.
But Aave's operating system doesn't stop there. What other modules are they running in this app store of theirs?
Well, they developed something called isolation mode, which is crucial for listing new, potentially risky assets.
Because usually if you list a bad asset, it can take down the whole system, right?
Exactly. Instead of letting a new token be used as collateral to borrow anything across the entire protocol, which could drain all the liquidity if that new token suddenly collapses, isolation mode walls it off.
Okay.
You can only borrow specific, highly liquid assets against it, and there's a really strict debt ceiling.
So it's like putting a new, unproven chemical in a quarantine chamber before letting it mix with the main water supply.
That is a very apt way to look at it.
Right.
And they also introduced high efficiency mode, or E mode.
What does that do?
It recognizes when a user is borrowing an asset that is highly correlated in price to their collateral.
Like what? Give me an example.
Like locking up $1 pegged stablecoin to borrow a different dollar pegged stablecoin.
Okay, so they're both always worth $1.
Right. And because the price volatility between those two is virtually zero, the algorithm allows for vastly higher leverage, sometimes up to 97% of the collateral's value.
Wow. But wait, all these features, flash loans, isolation chambers, high efficiency leverage. We just established a few minutes ago that in smart contracts, complexity equals vulnerability.
We did.
Amatsa is adding massive complexity here. So if the code breaks or if, some obscure vulnerability gets exploited by a hacker, who pays for it? The lenders.
And that is the defining tension of app has to manage. They embrace complexity through what they call risk-aware innovation. Because they know they're pushing the envelope, they built a decentralized insurance layer directly into the protocol itself.
The insurance layer.
Yeah, it's called the safety module.
So how does a safety module actually work in practice? Is it just a rainy day fund sitting in a wallet somewhere?
No, it's an active game theory mechanic. Users take their AAVE governance tokens, the token that runs the platform, and they voluntarily lock them into a smart contract, basically staking them.
Okay, why would they do that?
In exchange for taking on this risk, the protocol pays them a steady yield.
I see.
However, if a catastrophic event occurs, like a massive smart contract exploit, or a failure in liquidations that leaves the protocol with bad debt, the safety module acts as the ultimate backstop.
Meaning they lose their stake tokens.
Exactly. The protocol can automatically slash and sell off up to 30% of those staked tokens on the open market to cover the deficit and make the depositors whole.
So the users are actively underwriting the risk of the protocol's complexity.
Exactly.
They're getting paid a premium to act as their own decentralized insurance company.
It's a really brilliant way to balance their maximalist approach.
It really is. But this raises a question about the evolution of this whole space.
Yeah.
We have Compound, the minimalist bedrock. We have Aave, the maximalist operating system. If you're a developer looking at this today, is the only way to innovate to just launch a brand new competing liquidity pool and hope people move their money over to you?
Actually, no, not at all. In fact, trying to fracture liquidity by launching endless new pools is incredibly inefficient.
Right.
And this is where Morpho enters the picture. Morpho took a step back and realized they didn't actually need to compete with Aave and Compound for liquidity. They just needed to optimize the spread.
A spread optimizer. So what does this all mean for the user? How does Morpho sit on top of the others without just adding another, annoying layer of fees?
It utilizes a mechanism called peer-to-pool matching.
Peer-to-pool?
Yeah. So think about a traditional DeFi pool for a second. Lenders might earn, say, a 3% yield on their deposits, but borrowers are paying 5% to borrow those same assets.
Where there's always a gap.
That 2% spread is the inefficiency of the pool model. It's basically the cost you pay for having guaranteed instant liquidity.
Got it.
So Morpho acts as a routing layer. When a user comes to Morpho to borrow or lend, Morpho dynamically searches its own internal order book first to see if it can match a borrower and a lender directly, peer-to-peer.
Oh, I see. So it's essentially a travel aggregator.
Sort of, yeah.
Like going to a site that finds you a cheaper flight on an existing airline rather than trying to build a whole new airline from scratch.
The aggregator analogy is a really good starting point, but Morpho takes it a mathematical step further.
Okay.
If it finds that direct match, it cuts out the pool spread entirely. So the borrower might only pay 4% and the lender earns 4%.
Wow.
Both parties get a significantly better rate than if they went straight to the underlying pool.
But what if there isn't a perfect match? Like if I want to borrow $1 million of USDC right now, and there just isn't a lender on Morpho offering that exact amount, does my transaction just fail?
And this is the genius of their fallback mechanism. If Morpho can't find a direct peer-to-peer match in real time, the smart contract seamlessly routes your transaction directly into the underlying Aave or Compound pool.
Oh, instantly.
Instantly. You still get your loan right away, just at the standard pool rate. Morpho basically leverages the massive liquidity of those foundational protocols as their ultimate backstop.
That is incredibly clever.
Yeah.
It captures the efficiency of peer-to-peer matching, but completely eliminates the waiting game by utilizing the deep pools of Aave and Compound as a fallback.
Exactly. It improves overall capital utilization across the entire ecosystem, and it does it without breaking compatibility.
It's just operating entirely as an efficiency layer.
Yeah, proving that innovation in DeFi doesn't just mean building new pools over and over. Sometimes it just means optimizing the routing of the capital itself.
All right, I have to step in here and play devil's advocate for a second.
Dude.
We've spent the last, 10 minutes marveling at the architecture here. The elegant minimalism of Compound, the risk-aware complexity of Aave, the seamless spread optimization of Morpho.
Oh, very impressive.
It all sounds like this perfectly calibrated financial utopia. But we were talking about highly experimental, autonomous software managing literally billions of dollars.
Yeah.
Algorithms go wrong. What happens when the machine breaks?
Well, the source material is very explicit about the dark side of autonomous credit.
Okay, good.
The risks are profound, and they stem directly from the very mechanics that make the system so efficient in the first place. We are looking at massive threats like liquidation cascades, oracle manipulation, extreme collateral volatility, and liquidity crunches.
Let's focus on that first one. Liquidation cascades.
Okay.
I mean, the phrase alone paints a terrifying picture. Earlier, you explained how the robotic pawn shop instantly liquidates collateral if the oracle says the price has dropped. It sounds like the system is designed to be totally merciless, precisely when the market is the most vulnerable.
It is entirely merciless. Let's walk through the anatomy of a cascade so you can really see it.
Please.
Imagine a scenario where a macroeconomic shock hits. Maybe some global news drops, and the broader crypto market suffers a sudden 20% drop in prices across the board.
It's just a flash crash.
Right. Instantly, across Aave, Compound, and Morpho, thousands of borrowers suddenly see the value of their collateral fall below their specific algorithmic thresholds. And it happens at the exact same millisecond.
And the smart contracts just wake up and immediately start offering all that collateral to liquidators at discount.
Correct. But here's the catch. To realize that discount, liquidators have to instantly sell that seized collateral on decentralized exchanges to lock in their profit.
Oh, no.
Yeah. This sudden, massive flood of sell orders drives the market price of the asset down even further.
Oh, I see the death spiral now. By selling massive amounts of collateral to cover the first wave of defaults, they artificially depress the overall price even more, which then triggers the liquidation thresholds for the next batch of borrowers who thought they had a safe buffer just a minute ago.
And then that second wave of automated selling drives the price down again, which triggers a third wave of liquidations.
It's a self-perpetuating chain reaction.
Completely. The algorithms blindly follow the rules. They don't know there's a panic. They aggressively amplify market volatility and can wipe out millions of dollars of equity in literally minutes.
That is a staggering systemic risk.
It is.
And you also mentioned oracle manipulation. If the oracle is the eyes of the smart contract, what happens if someone blinds it or, feeds it a hallucination?
Well, if a highly sophisticated attacker can temporarily manipulate the price of an asset on a decentralized exchange, perhaps using a massive flash loan to artificially pump the price up for just one block walk,
Right.
the oracle might feed that artificially inflated price back to Aave or Compound. The attacker then uses their, temporarily overvalued collateral to borrow massive amounts of stable assets, and they simply walk away before the oracle price corrects itself.
Leaving the protocol holding a bag of essentially worthless collateral and a massive pile of bad debt.
Exactly.
Unbelievable. And what about a liquidity crunch?
So liquidity crunch happens when pool utilization hits 100%.
Okay, meaning all the money is lent out.
Right. If everyone borrows all the available assets, the lenders, the people who actually deposit that money in the first place, can't withdraw it.
They're just trapped.
They are trapped in the protocol until borrowers decide to repay, or until those super high interest rates attract new depositors to fill the pool back up.
So if this robotic pawn shop can trigger a catastrophic market cascade, fall victim to manipulated data feeds, and lock up depositors' funds in a liquidity crunch,
Yeah.
why are institutions and billions of dollars still flowing into this? What justifies that level of danger?
The justification lies in a really crucial counter perspective highlighted in the notes.
Okay, what is it?
DeFi risk is entirely visible, measurable, and auditable.
Transparency. It always comes back to the public ledger.
Exactly. Think about the 2008 financial crisis in traditional banking. The systemic risk was completely hidden inside opaque balance sheets, toxic mortgage-backed securities, backroom derivative deals.
Regulators and everyday consumers had absolutely no idea how much leverage was actually in the system until Lehman Brothers collapsed.
Right. The danger was completely invisible until it was too late.
Yeah.
But in DeFi, every single loan, every piece of collateral, every specific liquidation threshold, and every single line of code is visible on the public blockchain 24/7.
So you can literally see it coming.
Yes. Analysts can map out the exact price points where massive liquidation cascades will occur. They can run stress tests on the smart contracts in real time. The systemic risk is highly quantifiable.
Right.
So it is a highly dangerous system, yes, but it is a known danger, which is fundamentally different from the hidden time bombs of traditional opaque finance.
That distinction is monumental. The transparency doesn't prevent the storm, but it gives everyone a radar to see exactly when and where the storm is going to hit. Now, taking all of this into account, I have to point out a massive limitation to everything we've discussed today.
What's that?
Aave, Compound, Morpho. There are architectural marvels, sure, but they all require over-collateralization. You have to already be wealthy to borrow money. You have to hand over a $15,000 gold watch to borrow $10,000 in cash.
Yep.
That works great for crypto traders who are just seeking leverage, but that is not how the real global economy functions.
Not at all.
A small business doesn't hand a bank $1 million in cash just to get $1 million operating loan. That makes no sense. So where does this technology go when it hits the ceiling of over-collateralization?
Well, this raises an important question, and it is the exact frontier the industry is aggressively pushing toward right now. The source material outlines the next massive evolution of on-chain lending, and it moves far beyond just using crypto tokens as collateral.
Okay, so what's the next step?
The holy grail of DeFi is under-collateralized credit.
But how do you enforce an under-collateralized loan on a blockchain without a human loan officer or like a legally binding contract?
It's tough.
If I borrow funds without putting up collateral and just move the funds to a new anonymous wallet, the protocol is helpless. They can't come repo my car.
That's why the next layer of infrastructure being built involves decentralized identity and reputation systems.
Reputation systems.
Yeah. Protocols are trying to figure out how to mathematically quantify your on-chain history. So your past transaction behavior, your repayment consistency across different protocols to build effectively a decentralized credit score.
The decentralized credit score.
Yeah.
But even with an on-chain score, there has to be real-world consequence, right? Otherwise, people will just burn their digital reputation for a big payday, which is where I assume real-world assets, or RWAs, come in.
Yeah.
The note specifically mentioned this.
Yes, exactly. Tokenizing real-world assets like real estate, commercial invoices, or even U.S. Treasury bills, and representing them as tokens on the blockchain. This allows users to post legal physical assets as collateral within these smart contracts. Furthermore, we are seeing the rise of institutional credit rails. The source material specifically highlights protocols like Maple, Goldfinch, and Clearpool.
How do those differ from an Aave or a Compound?
They essentially act as a bridge between the blockchain and traditional corporate finance. Instead of purely algorithmic lending, protocols like Maple use what they call pool delegates.
What's a pool delegate?
They're essentially professional credit analysts who assess the real-world financials of a traditional corporation. The delegate approves the terms, but the loan itself is funded by a decentralized pool of crypto lenders and settled instantly on-chain via smart contracts.
Oh, wow. So we are looking at a macroeconomic shift where, say, a mid-sized tech company in Europe could secure a $50 million line of credit, but instead of going to a syndicate of Wall Street banks, they are drawing funds directly from a global, decentralized pool of retail and institutional lenders, with the terms enforced by immutable code.
Exactly. It completely flattens the global capital markets. The financial world is going to have to adapt incredibly fast as these decentralized, highly efficient rails start eating into the profit margins of traditional institutional finance.
Wild to think about.
The future of lending isn't just decentralized. It is borderless, completely transparent, and infinitely programmable.
It's just a staggering amount of innovation to process. Let's do a quick recap to anchor this all for you listening. We explored the foundations of a new financial physics. Compound proved that pooled lending and algorithmic interest rates could create a minimalist, stable bedrock. Aave pushed the boundaries of complexity, acting as a liquidity operating system with wild innovations like flash loans and decentralized safety modules.
Right.
And Morpho evolved the space further, creating an optimization layer to dynamically capture the spread between borrowers and lenders. Together, they are replacing the mahogany desks and the loan officers with transparent, autonomous smart contracts.
They've successfully built the plumbing for an entirely new financial system. But, there is a thought from the source material regarding that future of undercollateralized lending that I think is really worth lingering on.
Oh, what's that?
We talked about the inevitable shift toward digital identity and reputation systems to allow people to borrow based on their on-chain history.
Right, the decentralized equivalent of a FICO score.
But consider the implications here. If the future of global lending relies on decentralized identity systems to judge whether you are trustworthy, who or what algorithm gets to dictate the parameters of your reputation?
Oh, wow.
And when your financial access is denied by a line of code instead of a human loan officer, who do you appeal to?
Man, we started this deep dive criticizing the friction and subjectivity of human judgment at the bank.
Exactly.
But it turns out, when you remove the human completely, you are left alone with the machine. And appealing to the rigid, mathematical judgment of a machine might be the highest friction of all.
It's a sobering thought.
It really is. Well, thank you for joining us on this deep dive into the mechanics of decentralized credit. Stay informed, stay curious, and stay ahead as these technologies rewrite the rules of finance. Catch you next time.
1, 2,
Wanna hear you go.